Are we ready to rock and roll? Here we go. All right. And we begin. We last left off, we were looking at this chart of pound New Zealand during the first session. And I wanted to take a look at our S&P futures here. At ES is the symbol. I'm going to take away our little moving averages here. We don't need them right now. If you do have any questions, please feel free to get them in. During our previous session, we pretty much did nothing but answer questions, and it's wonderful. So please feel free to ask questions. It really keeps things moving right along. And you can see we're at all-time highs on the S&P 500, and according to the futures, we are going higher still. So what makes it keep going? What makes us continue to go higher? I believe personally that it's the belief that we're going to see some kind of tax reform in the U.S., some kind of tax cuts. And people think, well, how is that a good thing? I mean, if you cut taxes, doesn't that mean greater debt? Well, let's think about it for a second, right? If you have the highest tax rate, you're pulling in 35%. Okay, right now, the U.S. tax rate is 35%. But you're also hurting yourself because you're driving business away. There were many companies in the U.S. who left the U.S. through a strategy called tax inversion. What they did is they merged with companies outside of the U.S. and moved their headquarters outside of the U.S., and now they won't be paying any taxes to the U.S. So by having the higher tax rate, the U.S. gets 35% of nothing. I'll give you an example. One company is called Burger King. Most people are familiar with that company in the U.S., at least. It's probably one of the biggest fast food companies. It's similar to McDonald's and called Burger King. I can't say that I'm really fond of the place, but it's well known. And Burger King merged with a Canadian company called Tim Hortons. Tim Hortons is the Starbucks of Canada, I think you could say, and very well known in Canada. Tim Hortons merged with Burger King, and Burger King this way becomes a Canadian company and pays a lower tax rate in Canada and therefore avoids paying 35% tax. So now Burger King doesn't have to move a single restaurant, right? They still have all their U.S. restaurants, but they're no longer an American company, so they dodge those taxes and the U.S. loses out. Think of it another way, right? Because the U.S. has the highest tax rate, suppose you were opening a brand new company. Now, why would you base that company in the U.S. with a 35% tax rate when you could base it in Singapore and have a rate half as much? Have a rate of around 18% in Singapore. Why not base your company in Singapore and pay half as much tax? Makes perfect sense, right? So we'll never know how much money the United States lost because of companies that were never U.S. companies because of the high tax rate. But if the U.S. has a competitive tax rate, I think a lot of companies will open up in the U.S. that would have never been here otherwise. And other companies like Burger King will stop fleeing the United States for other countries for the lower tax rate. So you're going to have a lot more. I think in the end, you could end up with just as much money coming in with a lower tax rate. It's possible, because you'll have fewer companies fleeing the U.S. and other companies that will open in the U.S. that might, at the current rate, would never open in the U.S. Okay, and that's the stock market is reflecting this by hitting all-time highs on the S&P 500. Right, that's the effect of a lower tax rate being priced into stocks right now. And the dollar continues to go lower. DXY, stocks continue to rise, dollar continues to fall. And that's another factor here. If the dollar is lower, there are many US companies that are going to make more money because the dollar is lower. How is that possible? Well, there are many US companies like Caterpillar, right? CAT, C-A-T. Look at that, all-time high for CAT, if I'm not mistaken. Yeah, sure looks like it. What's the deal with CAT? Well, they sell earth-moving equipment, construction equipment, and they sell it all around the world, Europe, China, all over the place, right? They sell more outside of the U.S. than inside. So the more the dollar falls, the higher CAT goes, right? Look at it go, just all-time highs today on the CAT, right? Just a perfect example of a company that's going to benefit from a weaker dollar. Because why? Because they sell more stuff outside of the U.S. than inside of the U.S. And therefore, they're making, they're earning money in euros and in British pounds and in currencies that are getting stronger as the dollar falls. Other companies that fit this is Boeing is another one. All-time high on Boeing, if I'm not mistaken. Right? Yeah, look at that thing go. Boeing hits an all-time high. Another company that benefits from a weak U.S. dollar. Because Boeing competes with Airbus. Airbus is a European company, and as the euro rises, Airbus will be hurt and Boeing will benefit. Sure enough, right? There's an all-time high for Boeing. Johnson & Johnson. Not quite an all-time high, but getting close. Johnson & Johnson sells more than half of their stuff outside of the U.S. So there you go. If you understand Forex, you probably own these stocks right now. And I just named 3 stocks. 2 of them hit all-time highs yesterday. The third one is getting very close. These are all companies that do well when the dollar is falling, and the dollar is consistently falling right now. Okay, let's move on. I wanted to talk about Australian dollar. Earlier, during our first segment, we talked about how gold is pulling back after a great run. Copper is pulling back after a great run. And Aussie has had a great run. Is Aussie going to pull back? I don't know. This is what we call a cup and handle pattern. There's your cup, and this is your handle. This is an almost classic version, although we would like to see what we call a tighter handle. This is almost a classic version of the pattern, and it is a bullish pattern. Make no mistake about it. This is a bullish pattern. This is telling us it goes higher, despite the fact that copper and gold are falling. This is a bullish chart. And right now, as we speak, Aussie is 80 cents against the dollar, having come all the way up from 72 cents at the beginning of the year, right, to 80 cents. And you think that's had a run, but look at how much room. If I show you the weekly, you're going to say, oh, there's still room to run here, right? There's still a lot of room to run here. The key seems to be this line. And I'll remove that and put it in again. kind of this way. We've talked about this before. We're at this kind of inflection point right now. This was a major support level right now, and I say this, I'm talking about the area that we're in right now. It's around 81. This 8100 area was support way back in way back in 2010, and resistance in 2015, and here we are again dealing with this area again with this cup and handle. We're back into it again. So we could have a little bit of a rough time. What would help a lot is if this pullback, if the pullback in gold and copper, it doesn't even have to reverse. If it just stops pulling back, I think that's all that the Aussie needs to break through this. I think that's all that is really required here. But this is a major deal, and it's right above our cup and handle. Okay, that line, it's right about 81. That line's, it's kind of tough because we're going back 7 years with this line, and it covers a lot of ground, and it's tough to be precise. But I'm saying it's right around 8100. And that's about 100 pips away right now. You could see that we tried to pop through there about a week ago, and it just formed a shooting star, and that created the hand, that helped to create the handle, the pullback that forms the handle. All right, so, and also, if you take a closer look, this is not quite what I would call an engulfing pattern, these two candles, but it's going to feel like one if you sold short. The current candle that we're under, today's candle for Aussie, and we have to be careful because this candle is not closed, so we don't want to. 8160 says Carlos. Okay, Carlos might be looking at the top of this wick here. No? Okay. Carlos says, I bought the oversold on the 1 hour, but not planning to hold it. Okay. Here's what I'm looking at too. I think this little consolidation here might be about to end because of this. It's not technically engulfing, but it's going to feel like it because the body is engulfed. Not the wicks, but the body of the red candle is engulfed. True engulfing is hard to get in the Forex market because of the lack of gaps. But I will tell you this, if you sold short yesterday, you are feeling it today. Correct? On Aussie, you are feeling that today, and that does not feel good. That is not a very positive feeling. And this is where the psychological aspect comes into play. Right, is this. If you sold short yesterday you do not feel very good about this right now. And you're probably feeling, we've all been through this. Even if you're not in the trade right now, it's probably pretty easy to relate to the people who are in the trade right now. And that means if you have the least bit of empathy, you might be able to figure out where to that now's a good time to buy. But here's my thought process. Those who sold short just got their goose cooked, and they're not feeling good. They're feeling pain. It's sort of like putting your hand on a hot stove. They sold short yesterday, and they got burned. Now, whenever I put my hand on a hot stove when I was a kid, and it happened to me a couple of times, you know what I was really, really careful not to do? Is put my hand on it again. And even though it might, whether or not it makes sense to sell short again, those who sold short here are now going to associate that with pain. We associate putting our hand on that stove with pain, and then we make darn sure not to put our hand on the stove again. Just a Pavlovian response, right? Stove equals pain. Don't touch stove. Very basic, right? So somebody shorted here, and they felt pain. In their brain right now, it says shorting Aussie equals pain. Don't short Aussie. So a number of people who shorted Aussie right now, their brain is telling them, don't short Aussie again. And it doesn't really matter if you know better or not. It doesn't matter if you're a professional or an amateur, because this is working on a very basic level. I ain't going to do that again. We just don't feel comfortable with it. So what I'm saying is a number of shorts have been taken out of the equation. A number of people who would feel free and feel perfectly normal selling Aussie have been taken out of the game. Also, it's just the pure violence of this move, the way that it just rips the rug out from under the shorts here. The strength of this reversal just makes it that much more likely that they're just not going to go back in. It hurts too much. I don't see it happening. Price bounced back for the short, saying, "Say hello, my little friend." Yeah, exactly, right? It was actually a very disconcerting, a very disconcerting moment, shall we say? And this was not a happy moment. And it continues, really, to go against them. And this is not a fun time. And really, you could probably say that about not just for yesterday, but even for a couple of days prior to that. Today's candle is really engulfing several days worth of activity. And, it's probably just taking basically 3-4 days worth of shorts to the woodshed all at once. And this is going to make sure that a whole lot of folks who were saying, this thing has run its course, they're not going to be feeling that way again. Yeah, it's not going to happen. So there may have been, if I go back, I could have sworn, was there something last night with Aussie that kicked this off? I wonder. Yeah, there was, I'm sorry, the RBA meeting minutes may have been the catalyst for this move. And I believe that's what set this in motion. So I'm not even sure exactly. I missed this last night. I'm not sure exactly what they said. It actually sounds like they were trying to talk it down. They said a further rise in Aussie would slow growth. So it actually sounds like they were trying to talk Aussie down, but didn't work. Did not succeed. So there you have it, right? So it just goes to show you, right? Central banks are not all powerful after all. Anyway, they tried to be a little bit, they weren't really dovish, I guess. They were just basically warning folks, hey, you know, if this thing keeps going up, it's going to slow us down. It's going to slow down the economy, which is a way of trying to talk it down, I suppose, but it didn't work. Anyway, but that seems pretty bullish to me. Bottom line is it's pretty bullish. This is pretty bullish activity. It's a bullish pattern. Cup and handle is known to be a bullish pattern. The caveat is that you have a sort of a bearish piece of resistance up ahead. But if you can get through that, there is an awful lot of room to run beyond that. And you know, the way that things are developing and the way that trends are developing, I feel comfortable going with the trends and, you know, betting against the dollar. And eventually, you know, betting against the dollar won't work anymore. But you have to, you don't have to do anything. I shouldn't say you have to, but you have to respect the trend. I do. I have to respect the trend. Trend in the dollar is very strong. It's been very strong since the beginning of the year. Aussie hasn't been the strongest currency, but you know, we had a report from one bank last week saying that they felt the RBA was going to raise rates 4 times over the next 2 years. And you know, if China is growing, and if we can see if we see gold and copper and silver can get back on track, then it's going to happen sooner rather than later. So those things could happen. Now New Zealand looks very different, right? Kiwi looks very different from Aussie, doesn't it? We'll take a look at Kiwi next. Kiwi, I tried to short it off of this channel and it didn't work. Popped through the channel, obviously. And I guess I wanted to have at least one currency pair where I was betting on the dollar, right? Because you can't turn your entire account into a big bet against the dollar. But it failed. You know, it did not work out. And that's going to happen sometimes. But this is not really, this goes to show you, we were in a downtrend here for quite a while on Kiwi. And when the downtrend broke, we did not immediately go into an uptrend. We just drifting sideways now. We are just drifting sideways. And now here, this has all the look of an engulfing, right? But there's no direction, so it really loses its meaning. Reversal patterns really have no meaning without direction. You know, whereas with Aussie, we were, whoops, there's the opening bell for the U.S. Stock markets. We have no direction here. This is perfectly range bound and sideways for Kiwi. Why? Because there is no, this is a commodity currency, but the commodities are completely different in New Zealand as opposed to Canada or Australia. Canada and Australia have a lot more in common. Canada and Australia are hard commodities, very similar with the exception of oil. Oil is a big export of Canada, not so much of Australia. And but New Zealand is soft commodities, right? Milk, lamb chops, sheep, you know, Lord of the Rings movies. You know, it's a very different. I think of New Zealand as a big farm, and I think of Australia as a big mine, and you could think of Canada as a big mine that also has oil wells and lumber. Economically, of course, all those countries have a lot more going on, but I'm just talking about the economies of those countries. Economically, you could think of Russia as just a big oil company. You know, that's it. You know, so when the price of oil collapsed, the ruble collapsed with it and never really recovered. You know, because the price of oil never really recovered. You know, you're basically dependent upon a single export. Right? And which makes it interesting if you're the US, you know, and you have the ability to increase your production. And basically, you don't have to fight wars against your enemies. You can drive your enemies under, like Venezuela was never a friend to the US. And you basically you can put your enemies out of business. You don't have to fight wars. You can economically undermine your enemies by simply putting them in a tough spot, by driving down the price of their chief export. Think about it. You could absolutely change the face of the global balance of power. In the 1970s, countries used oil to try to bring the United States to its knees. Try to use the U.S. dependence on oil to try to bring the U.S. to its knees. Now, the U.S. could use its own production of oil to try to drive the price of oil down, to try to put the shoe on the other foot. It's amazing how times have changed. Okay, that's going to wrap it up for this session. But I'll be back on Thursday. Now, I need you to be very careful tomorrow. Today, the Fed meeting begins, but it will not end until 2 p.m. New York time tomorrow. So on Wednesday, and I won't be here with you tomorrow, but you need to be very, very aware of this. Wednesday, 1800 GMT, Fed interest rate decision, and FOMC economic projections. Even though there is no expected move in interest rates, we do think that there will be a lot of volatility. Okay? So that is expected. So be careful, act accordingly. Maybe don't open up any short-term trades right before 1800 GMT tomorrow. Okay? Keep that in mind. Okay, and I'll be back with you on Thursday, and when the dust settles, and we'll see how things shake out. Okay, this has been Ed Ponsi on behalf of FX Street. Thank you for listening. I'll talk to you again very, very soon. Thanks for listening.